I don't want to compare myself to Martin Luther King, but I feel like, I have a dream or I have a vision. And that's well, in fact, I actually went to India in 1991 with a meditation group and actually had a 2-day transcendental experience, which I know that we people are capable of another more enlightened state than we're in now. But it's Maslow's hierarchy of needs that you've got to start at the bottom with. First, you got to feed the people and get the shelter and stuff. And so it's sort of like whoever it was said, all right, now you've seen it, you know what's possible. So figure out how to get there. What I want to talk about tonight is that people say, well, we've got, the reason we haven't gotten these 20 bills passed, that we've got 20 states that have bills pending for state-owned banks, but they haven't passed yet. Like in California, I think California got the farthest. So we had a bill 3 years ago that passed both houses of the legislature for a feasibility study, but Jerry Brown didn't sign it. And what he said was, we don't need another committee. This is supposed to be a blue ribbon committee, so we don't need another committee. We can do this in-house, but then they haven't done it. So it's like what Mike says, they could do it. If they had the will, they could do it. So our job is to give them the will, to show them that this is a no-brainer, that you can make money this way. This is actually the answer to your funding problems. Every legislator we should be able to convince them that this is quick, easy, and we'll get them money right away and we'll solve their funding problems. A few years ago, I called the California Treasury Department, and then the Washington State Treasurer, they both said, we don't have the money to lend, we need our deposits for our budget, which shows that they don't understand how banking works. And they say we can't afford the capital. We can, and I'll show how they can afford the capital. They'll say, we can't wait for decades for this bank to become profitable. It won't take decades. In fact, you could do it overnight because it's really just an accounting function. You could do it with one guy in an office who's just working with a computer. They will say that it's too risky, that making loans into the community is too risky. In fact, there's a way you could do it that would be virtually risk-free, which I will explain. They're actually facing a huge risk right now with the bail-ins, so it's much less risky to be putting your money in your own bank. So in order to understand why this is a no-brainer, first we need to go into the basics of banking, which actually we avoided this up till now. I know one woman who has worked really hard for a California state bank. She says, I never bring up the fact that banks create money because nobody believes that. And so so then you try to do it some other way and say, well, of course we should have our own money and all the things that we always say. But the real value of a bank, the thing about a bank that's different from anything else is that banks have this alchemical ability to create money on their books. You can tell that from a chart of the money supply, which this is. Okay, the top one is M2. So that's basically the circulating money supply, what we, the people, have access to, not what's in the reserve accounts, but what we trade with. Most people think money is created by the government, but in fact, the only money that the government creates are coins. And that is, I think, about $1 billion. So it doesn't even show up on this chart. The red line is M1, which is coins, dollar bills, and checkbook money. You could argue that dollar bills, some people would say dollar bills are created by by the government, but in fact, they're Federal Reserve notes. A note is a promissory note. The Federal Reserve is composed of 12 branches, all of which are 100% owned by the banks in their district. And if it were actually the Treasury creating it, like the American colonies did, where they created money, they would just spend it into the economy. They wouldn't be lending it to us. So that's the thing. All of our money is created as a loan, and the loans are always at interest. So there is always more money owed back than was created in the first place. And where does that money come from? It can only come from more debt, because that's the only place that we can get money. So that's a pyramid scheme, and it's unsustainable. So in order to make this sustainable, we need to retrieve the power to create money. Ideally, we could do that by through the Treasury. If we, the people, had enough control, influence over Congress, Congress could decide to just print the money and spend it on the things that they need. Goods and services, this would not actually be inflationary because your supply would go up along with demand, so prices would stay stable. So it would not inflate prices. But it's very hard to get Congress to do anything, and especially with our current Congress, which is Republican-dominated, so therefore opposed to anything that would hurt the big banks, et cetera. Not that this would hurt, I would argue that it won't hurt the big banks, but anyway, it'll hurt the control issue, as Nomi says. Many different authorities have said that banks create money, but this one I really like because he's just so explicit on how it's done. Robert B. Anderson was a U.S. Treasury Secretary under Eisenhower in 1959. He said, when a bank makes a loan, it simply adds to the borrower's deposit account in the bank by the amount of the loan. The money is not taken from anyone else's deposit. It was not previously paid into the bank by anyone. It's new money created by the bank for the use of the borrower. The Bank of England actually just a year ago came out with a directive saying just that. They said, contrary to popular belief, banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. In other words, the money multiplier theory is obsolete. Commercial banks create money in the form of bank deposits by making new loans. So they do it by double entry bookkeeping. So for example, if you go for a $500,000 mortgage, you will sign a promissory note for $500,000, and that is actually a negotiable instrument. So the bank will write that on one side of its books as an asset to itself because you have agreed to pay that back over time. And then they'll write the same $500,000 on the other side of their books as a liability to themselves, because when your $500,000 check goes into your seller's bank, the first bank is going to have to cover that check, so they're going to owe that money. So you may ask, why do they need the deposits if they're actually creating the money on their books? The reason is that they have to balance their books at the end of the day. So you have checks coming in and going out all the time. You're supposed to keep a certain amount in your reserve account, usually 10%. So if your reserve balance goes below that 10%, the Federal Reserve will treat that as an overdraft, and you will have to fix the overdraft, and you can do it by moving some reserves from somewhere else. So basically, the bank borrows in order to balance its books. So the cheapest place they can borrow is from their depositors, which at Chase right now, for example, it's 0.1%, and that is on a savings account. So that means that if you put $10,000 in the bank and leave it there for a year, you will get $1 back in interest. So the money market, 0.15%. Fed funds, that's where you borrow from other banks. You borrow the reserves from other banks, 0.25%. If they have to, they'll resort to borrowing from the Federal Reserve. They don't really like to do that because it sort of gives them a bad name, but it's 0.75%. So no matter what, it's very cheap compared to what they're getting on these loans. Like if it's a mortgage, it might be 4 or 5%, or business loan might be 8%, or if you're talking credit cards, et cetera, it's higher and higher. So there's a very nice spread, which is their profit. Now, small banks will tell you that they only make like 1% on the spread because their costs are so high. But if you're a public bank, your costs are almost nil. You have very low costs, and so you actually get to keep most of that spread. And that's the main reason that public banks are more profitable than private banks. For example, the Wall Street Journal came out with this article in November of 2014 in which they said, I just thought this was a good opening, so I'll quote it. It is more profitable than Goldman Sachs Group Inc., has a better credit rating than JP Morgan Chase, and hasn't seen profit growth drop since 2003. Meet Bank of North Dakota, the U.S.'s lone state-owned bank, which has one branch, no automated teller machines, and not a single investment banker. Return on equity, a measure of profitability, is 18.56%, about 70% higher than those at Goldman Sachs and JP Morgan. That particular article said it was because of oil, because they got the oil deposits from from the state. But that wasn't the reason, and I wrote a whole article saying why that wasn't. But also you can see that it's not the reason, or we have other evidence that public banks outperform private banks. This report just came out in January of 2015, just this month, from the Sparkassen Group, which is the public banking group of Germany. The Sparkassen banks they do most of the commercial lending in Germany, so they have a strong public banking sector. This report showed that the Sparkassen public banks, along with the regional banks and credit unions, they have about the same in the way of deposits and about the same in the way of loans as the private commercial banks, including the big, Deutsche Bank's their biggest private commercial bank, I think. But the private banks paid less than half the taxes, and the public banks, even with that high tax bill, came out more profitable than the private banks. So these charts are a little hard to see, but you can see the orange is the Sparkassen Group, and this is profit before tax. You can see that the orange has far exceeded the light blue, which is the private commercial banks. That wasn't actually true in this chart goes back to 2003. So from 2003 to the collapse of 2008, the private banks actually did better. But the Sparkassen have now well overtaken the private banks. So this is the same net profit before taxes as a percentage of average total assets. You can see the green, the Sparkassen have far outdistanced the blue, which is the commercial banks. After tax, again, the Sparkassen, the green is still way ahead of the blue. Return on capital before tax, again, all these charts, the green is just doing much better than the blue. So I'm going to post this PowerPoint on my website in case you want to study these charts, which are pretty impressive.
Now on the Sparkassen is shown as red on the screen.
Oh, I'm sorry. The orange is the Sparkassen Group. Okay, so why did the public banks do so much better than the private banks? Well, let's take the Bank of North Dakota model. They do not have to advertise at all. They don't have to advertise for depositors. That's what your small regional local bank would have to do. They'd have to compete to get deposits, and they have to pay more interest on their deposits. The Bank of North Dakota has a captive deposit base, which is the tax revenues or the revenues of the state. They don't pay bonuses, fees, commissions. Their CEO is, I think, around $240,000, so they don't pay much for their executives. They don't have branches, except the one branch in the capital city. They don't have ATMs, and they don't go out there and do the work of figuring out who's creditworthy. They don't deal with the customer. The customer is dealt with for the most part. They do make some direct loans, but for the most part, they partner with the local bank, which is sort of like the front office. That this is good for the local bank. They get the business, and they get to charge the fees and so forth for doing the business, and then they get this big partner that will help them with capital and liquidity. But from the point of view of the Bank of North Dakota, it's very simple. They look around, they find the good loans, the ones that they actually want to support, and then they put in capital and liquidity, and they get a cut of the proceeds. Legislators often say, we don't have the capital, where are we going to find the capital? They don't want to go into debt. They don't want to go and hit up their tax revenues. But there is a way that they could actually do it that would cost them nothing. They can actually finance the whole thing. So let's say you want to set up just a small pilot project type bank. $20 million will get you a bank in California. So you need $20 million for your capital. So California actually has $600 billion in various funds around the state, rainy day funds, and including the pension funds, et cetera. So $20 million is almost nothing. The treasurer himself manages an investment pool that has $60 billion in it, currently invested at 0.23% interest, almost nothing. So let's say you take $20 million from one of those rainy day funds, Or you could do a bond issue, either way. And let's say you offer them 3% interest. That's going to be a lot more than they're making in the Treasurer's investment pool right now. So they're going to be really happy about that. Your cost of funds is going to be 0.6 million. Then you pull 200 million in deposits out of your Wall Street bank, because with a 10% capital requirement, you can support 10 times your capital in deposits. And then you hold back 20 million in reserve because you have a 10% reserve requirement, and that leaves you 180 million that you can lend. But let's say you want to do the safe, quick, easy thing that makes you a guaranteed return overnight. You don't have to do any work for it. You can invest that money in bonds, municipal bonds. You're going to help out the municipalities by stabilizing the municipal bond market. So let's say you get paid 3% on these municipal bonds. So you're going to be paying out 1 time 3%, and you're going to be taking in 9 times 3%. So you're going to be taking in a lot more than you're putting out. These are your own state deposits, but let's say you pay yourself 0.3% interest because you were probably getting 0.2% or something at Chase. So your cost of funds is 0.54 million. So if you deduct all that from your profit, which was 5.4 million, so if you deduct your cost of funds, you're left with 4.26 million, which is a return on equity of 21%. And you can do that like in a matter of days. You just put one guy in an office and you have him do this, so set up an online sort of bank. So you're instantly profitable and you're taking almost no risk. You could do it with the pension funds. Maybe you don't want to do a bond issue because maybe you don't want to go further into debt, even though you're going to instantly get the money back. But maybe there's all this resistance among the legislators. So you say, fine, we'll borrow it from the pension fund, which is a state pension fund. I mean, it's still public money. They want 8%. Now, they're not actually getting 8% these days, but that's what they like. So we'll say, okay, fine, we'll give you 8%. That puts your cost of funds up to, for your capital, up to 1.6 million. So that lowers your profit a bit, but you still are going to make 16.3% return on your, just doing this like overnight. Let's say you held back 30% in reserve because you're a small bank, and it's better to have a bigger reserve for a small bank because it's not that easy to get your instant liquidity, et cetera. So even if you hold back 30% in reserve and you do a bond issue or you use your rainy day funds, your return on equity is still 16%. So if you did it with pension funds, and you held back 30% in reserve, at least you're making 11% interest overnight on just by pulling your money out of Wall Street, doing exactly what Wall Street is doing with your money right now, and you're putting it in a very safe investment. You don't even have to worry about loan officers, et cetera. You really don't need any employees except one math guy to work all this out. But of course, you'll want to be making loans into the community. So after you build up a little capital base, or if your legislature is willing and they're fine with a little bit of risk, then you can immediately start lending out that 180 million into the community for those things that the community needs. And you, assuming they're what's called self-funding loans, you'll get your money back. That's what Roosevelt did, was made all these self-funding loans during the 30s. And they made a profit. They like rebuilt the entire country with their own, it was the Reconstruction Finance Corporation because they couldn't get the Fed to do it. So it was their own state-owned financial institution, or government-owned. And they actually turned a profit at the end of all that after World War II, and they rebuilt the entire country and financed World War II. But what they invested in were what are called self-funding loans, which means things that will pay back. So solar, for example, would be one of those things, or roads and bridges and all these things that you can maybe charge a toll for, or various forms of energy that you get your money back. These figures are from Margaret Kennedy, who is a German researcher, and she got them from the Bundesbank. She found that 35 to 40% on average of the cost of public projects is interest. So this is another major savings for your legislature, which I said this before, but California, for example, is looking at a $700 billion bill for infrastructure over the next decade, which they absolutely don't have. So if you can cut your costs in half by funding it yourself through your own loans, plus you're saving all those fees that when you go through Wall Street and they do a bond issue, they take huge fees. And they don't even tell you. I mean, it's like buried in their contract, and it's considered a trade secret, and you can't even find out if you, with freedom of information, you still can't find out what kind of fees that we, the taxpayers, are paying. So you save all of that by funding it yourself, using your own deposits, leveraging your capital and deposits, just like the Wall Street banks do. For infrastructure, it's actually 50% that you save. I saw this in an article that's standard procedure to assume 50% for interest, for financing. So the Bay Bridge retrofit was $6 billion in principle. And by the time they add it on interest, or when they're done paying it off, the interest will be another $6 billion. The bullet train, the initial outlay, the part that was approved by the voters was close to $10 billion. By the time they tack on interest, it'll be another $10 billion. So all that could be saved by funding it through your own state-owned bank. Then there is the issue of safety, that we now have this whole bail-in situation. I just went into this earlier, but the state and local banks think that their deposits are safe because they're collateralized. But this collateral, it's like pooled collateral, or even if it's not pooled collateral, they're using that collateral for multiple things. And when they have a big derivatives bust, derivatives are going to go first in a bankruptcy. They're going to take all the collateral. So there could well be nothing left for either the state and local governments or for the FDIC. And this was actually formalized in last November by the Financial Stability Board. The G20 voted on, or they all, actually they just, I think they just shook hands on it, but or maybe they voted. Anyway, they all agreed on this whole bail-in resolution mechanism. I think they're supposed to take comments and then they'll actually formalize it early in this year. But at that point, you, the depositor, can't even go to your bank and sue them for your money back. This is just the law. That's what the law is, that they are being instructed to take our deposits in order to recapitalize themselves, in order to save themselves at our expense. And the reason they can do that is that legally, when you put your money in the bank, it becomes the property of the banks. And all you have is an IOU. You become a creditor of the bank. So the new rule is they take the money of the creditors and they turn it into equity. I just like this little joke. It's a stick-up. He says, give me all the money in my account. That was after the Cyprus event. This chart just shows you what we're talking about here. That this was a bit outdated. The FDIC fund actually has a bit more than in this chart, but the FDIC fund had $25 billion in it to insure $9,283 billion. In other words, $9.238 trillion in deposits, although I think only half of those are actually the kind that are under $250,000 that the FDIC fund actually insures. So $4.5 trillion. And then the real risk is that red line on the right, which is the derivatives. So the derivatives exposure is close to 300 trillion. So how can we eliminate interest, protect public deposits, and multiply public revenues? Own the bank. So that's all I got. Yeah.
North Dakota has about $6 billion, I think, roughly in assets right now. And I'm not sure how much they count as reserves, but I know it's a pretty big amount. And Colorado is roughly 7.5 times bigger in terms of population, economy, and so forth. Would it make sense to start off a bank in Colorado with, say, $42 billion of revenue bonds or general obligation bonds?
It would, if you can convince your legislature that they're going to get that money back immediately, which they would if they did it in, if they structured it right. They certainly could. So again, it's just a question of persuading your legislators that this is a no-brainer, that this is really what they should be doing.
Or the voters, if we do it as an initiative.
Oh, right, as an initiative, yeah.
As you may know, there's been a problem in Colorado with the legal marijuana industry not being able to bank. Mm-hmm. Would a public bank give them that opportunity? Could they put their money through a public bank?
Well, you could, of course. It's all in your legislation. But it seems to me it would be difficult to persuade your legislators to do it because the reason you can't get your banks to do it is because there's that risk that the feds will come in and shut them down because they have a rule against it. So probably you don't want to do that right away. You probably want to do your pilot project, see how well that works, and then keep adding things on as it works out well.
You can leave the drug trafficking to the CIA.
Okay.
I think, a feasibility study in the state of Colorado is possible, but the thing that I really worry about is orthodoxy and the idea that we have to measure our success by interest. In a regional bank, I forget what Gwen calls it, I call it a regional bank, but it would seem to me that the primary measure would be social well-being. And economists do this all the time. I mean, it's not just interest. It's what the community looks like after you put the money into these local communities. And so how much resistance would there be from the traditional interests to finally doing something that is external and, broad about how well we do with our money?
Well, it seems to me that what you want to do, ideally, is sell it as a win-win-win. If you can persuade everybody that this is good for them, and it seems to me we may probably have to wait till the next crash. They always say crashes that's when real change happens. That's when people are willing to do radical things, and that even Wall Street might be fine. If we can say, we can fix this for you, we can bail you out, we're not going to throw you in jail. Good news, you're not going to jail. We're just going to nationalize your bank and everything will be fine. And they might go along with it, if they can save they can save all those earnings they made or whatever. So I think resistance is how you frame it, and that's our challenge, is to figure out a way to frame it so that everybody thinks it's a great idea and everybody sees a benefit in it for them and nobody feels that their kingdom has been threatened. But even like Ralph Nader wrote that book, Only the Rich Can Save Us. It seems to me we just, they've got the money. Willie Sutton, why do you rob banks? Because they've got the money.
Hi, I attend the University of Colorado, and I'm a sustainability minor. And you said when you were explaining why inflation wasn't a worry, something along the lines of the supply will increase with the demand, so there won't be any inflation. But that kind of, how do I phrase it? How do you reconcile the idea of an increased need for supply with the limitations of the planet, and how that's, because my big thing is reconciling any economic system we have with our need to not be perpetually exploiting the earth more and more and more.
Mm-hmm. Well, we're talking here, I totally agree with that, and I know that issue. But we're talking about giving people jobs. I mean, are you going to say, let's starve a bunch of people so that we don't use extra food? We also have a duty to people to see that they have a basic standard of living. And that's what these basic income guarantee plans are all about, is just making sure people have the minimum to meet their basic standards. And there are many things that you could invest in that don't take any assets at all. I mean, first of all, there are all kinds of jobs that are just service jobs that don't use resources. And if you put money into education and to development, research and development, you could develop ways of saving the ocean, saving the air, saving like permaculture, things that are more efficient than the way we're doing things now, that would actually maximize our use of our current resources. So it's just I know there's the Mondragon is a cooperative in Spain, and they have, among their college students, they have what's called the Department of Good Ideas. I thought that was a great. So in the Department of Good Ideas, they think of ways, things that they can invest in. So you could have a department where the whole goal is to think of ways to save the planet, to maximize our use of resources. So you don't have to be spending, or you don't have to be spending on superfluous things. It seems to me that you can change the whole attitude so that you're putting that money into very efficient things.
What would a potential collapse look like, and what would be the likely triggers?
I suspect the trigger will be that a big derivatives crisis. It could be oil. It could be the oil collapse, just like the subprime loan collapse. And that this time, the government's going to say no more bailouts, which is what they said in 2010. Instead, they'll be bailing in our deposits. And that will bring an instant bank run. Everybody's going to run to the bank and pull their money out. And then they're going to be looking around and saying, well, now, what do we do with our money? And then they might, if we can plant some seeds, they'll say, what about that state bank idea? That wasn't a bad idea. So that's what I'm hoping, that we can catch them, before it's a great disaster, just sort of catch them in between as you're falling, you're looking over the cliff and then you change systems. Well, I was actually going to write an article on this, but haven't done it yet. In the last 300 years, we have changed systems every 20 years, on average, every 20 years. So, the best example was in the 1930s, and they didn't have the reserves. There was, not enough gold. So Roosevelt closed the banks in 1933, and when they opened up, he said, new rules, no problem. We're not going to use gold anymore. We're just going to print the money. And that fixed the problem. They just changed the system. So they could do the same and say, new rules, we're just going to make credit a public utility and simplify everything and guarantee everything, and it's all going to work out fine. They could. I don't know that they will.
I had a different question, but I would like to follow up on that one if I could. To me, it's phenomenal that they're headed to a disaster. They've known this probably for as long as they've had the system in place. Have you ever thought that perhaps this is actually intentional and that they were looking at Act 1 and this is Act 1 and there's an Act 2 and possibly an Act 3?
Yeah, that's actually my next book. I think it's definitely intentional among a certainly not everybody. In fact, hardly anybody, but there is a certain core. Who is the wizard behind the curtain? We still haven't figured that out. And I think those people, that element actually had that intent all along to basically own everything, to force us all into debt, so that to force us to privatize everything, to turn all our companies over into shareholder type, sell off the ownership of the companies, and then the big money would come in and buy it all up, and they'll wind up owning everything. And that's actually Carol Quigley wrote about that in his tome.
Cool. Can I go back to my smaller question that brought me to the microphone? When you mentioned municipal bonds, a kind of red light went off in my head that when public banking comes in and you've got all these powerful interests who'd like to see it die, the sooner the better, we have to be very robust in how the thing gets implemented. And municipal bonds in California, I think you've got, 40 cities that are bankrupt? So my question is, how do you prevent a public bank from making loans that are politically popular? Let's hypothetically say that the cities want municipal bonds to be purchased. The cities can't pay them back, so that's an obvious disaster. How do you keep that kind of an obvious disaster from affecting public banking?
Thank you. One problem with, one reason cities go bankrupt is because their interest rate floats. Or look at Greece, for example. Their interest rate went up to 30% at one point. Well, so that totally magnifies your debt. So if we buy their municipal bonds, we'll stabilize the bond market. The reason that the U.S. never goes bankrupt, even though we have a giant debt to GDP ratio, is because the Federal Reserve buys up all the extra bonds. So the state could actually, a well-funded state with a good credit system, could save those cities from going under. In fact, that could be one of their mandates.
Thank you so much, Ellen. That was wonderful.